Hello everyone, this is Professor Kent. Today's recording is for Chapter 8. Chapter 8, we're going to be talking about capital gains and capital losses. Now, this is an overview of this chapter, capital gain and capital losses. When we think of where do they fit in our income when we're filing for our income taxes. So we already talked about income tax Act 3A, which was to calculate your income from employment, from business, and a property. And your Income Tax Act 3D was calculating the losses from employment, business, and property. So that's what now your 3B is your taxable capital gain and allowable capital loss. It is not a source of an income. Instead, when do you get a capital gain? When you dispose a property. When you get a capital loss? When you dispose a property. That's when we have a capital gain or a capital loss. If you sell it for more, you have a gain. If you sell it for less, we call it that you have a capital loss. When we think of it, we think of a taxable, or we call it allowable. So this is what this chapter is going to be. How do we calculate our the taxable? My pen is not working, so I'm trying to get the pen to work. When we think of our taxable capital gain, what do we mean by taxable? When we think of an allowable, what do we think about that? Before we get to that, we needed to say that not a source of an income. Instead, your disposition of a property, you could dispose a depreciable property, non-depreciable property, or a personal property. Now, if you think about it, this is a good example. What properties are depreciable, what are non-depreciable, where do they sit when you dispose that? Now, if you think about it, if you have a personal property, it doesn't go anywhere. If it's an inventory, they go under your business. If it's a depreciable property, depending on where, they go under these three sections. And it's a non-depreciable property, it will only be going under your business and your property. It does not go under my employment. Now, you could have a capital gain or you could have a capital loss. When you have a capital gain, only applies to, it does not apply, capital gain does not apply to your inventory, but it does apply to your depreciable and non-depreciable and on personal property. Same thing with the capital losses. You are not allowed to do a capital loss, but we have non-depreciable. You will have a capital loss and you will have a personal loss. Think of it when we talk about recapture and terminal loss. When we talk about recapture and terminal loss, think of that way in this one. So now, when we think of a capital gain and capital losses, the rate changes every year. So it hasn't, not every year, but it's some point of a time. So it was half, your rate was half, which we call it 50%. In 88 to 89, they changed it to 2/3, then it went to 3/4, then it went to 2/3, and now we are back to 1.5. So these are the changes. Who tells us these changes? The income tax. They tell us what the rate to use. So when you have a capital gain, we're taxable at, we only report 50% of that. So we are total capital gain, we multiply the 50% to get your taxable capital gain. So now we have it says when do we have a capital gain and when do we have a capital loss. Capital gain, if the sale price of the capital property is more than the sale price is more than the cost. If it's more than the cost, you are going to have a a gain, and we call it you're going to have a capital gain, and then from there we need to convert this capital gain to taxable capital gain. When we think of a taxable capital gain, all we have to do is, depending on when you're doing it, you multiply by the 50% to get your taxable capital gain. So now if your sale price is less than your cost, if sale price is less, what we have is we have something called a capital loss. If it's a capital loss, we multiply by 50, and we call it allowable capital loss. Now it says only 50% of either is used in the net income calculation, and I show you only 50% is used. Now when we're going further, now when we think of a ownership, when we think of ownership of an asset, that's what we mean. Under ITA applies to a concept referred to as a beneficial ownership. There's two type of ownership. First one is a beneficial, the second one is my real owner. So real owner, when we think of it, is there a difference between both? Yes, there is a difference. Now, if this one is easy, legal owner is the person that has a legal title to the property. That's what it means. They have a legal property, legal title to it. When we think of a beneficial owner, beneficial owner now beneficial owner identify as a person who has a ownership rights that includes possession, use, and a risk of a property or a legal liability to enforce these rights against others, such as a legal owner. So beneficial owner, in other words, say, is benefiting from the asset. That's what it means. Now when we think of a disposition, we call it a sale. So disposition is, we call it a sale. Any transaction or event entitling a taxpayer to proceed of disposition of a property. So we call it a proceed of disposition of a property. Includes what? A sale, a redemption of a shares, majority of a bonds, repayment of a loan, expiry of an option. These comes under disposition. And disposition of a property, these are some of the properties that comes in. Now when we think of proceeds of disposition, in Income Tax Act 54, it is defined the sale price of the property that has been sold. So that's what POD, if you see a word POD, is the sale price of the property that has been sold. What does that include? It includes the compensation received from the insurance company on a property stolen or a damage. Of course, the sale price is what you're getting, the compensation. If something happens to your property, and then what happens is that if there's a fire happen, theft happen, the insurance company is going to give you money. The money that is called the compensation. So it includes compensation received from insurance, and instead of you selling that property, property is gone. If the property is gone, then what we're going to do is we're getting a compensation from the insurance company. The money that you're receiving will be called a sale price. Going further, we have a deemed proceeds of disposition, that is called deemed from a deemed disposition. That's deemed disposition is you sold the property. They're called deemed disposition. Adjusted cost base under the Income Tax Act 54 represents a cost of the property sold to measure a capital gain or a capital loss. So in other words, adjusted cost base is the cost of the property that is in your books. Now when we think of it for depreciable property, ACP is as capital cost. On non-depreciated property, ACB cost is cost plus any adjustment or minus any adjustments. We might think of it, if you add something and you subtract something for the non-depreciable property, and that will be your ACB. For depreciable property, your capital cost will be your ACB. So we think of an ACB is from the income tax purposes, and capital cost or a cost, we think of it from the accounting purposes. When we calculate the gain and loss, there's a steps to calculate the gain and loss. And how do we calculate that? First, your step number one is to calculate if there is any gain or loss. How do we do that? Only the gain or a loss on a disposition of any property. It could be a depreciable property or an inventory. Now there is a basic calculation. So contains a basic calculation which is subject to modification. That's the first thing you're going to do. Is at this point we just want to know if there's a gain or a loss on disposition of any property. Now the other thing is, do we have a capital gain or a capital loss? Now rule is capital gain or capital loss are on an inventory or capital, and you have a capital losses on a depreciable property. So when we think of it, you could have a gain and a loss from an inventory. You could have a both. But when you have a depreciable property, we think of it a capital loss. That's what we think of it. Step number 3, if you have a taxable capital gain or allowable capital loss, when does that happen? Taxable capital gain as 50% of your capital gain. So taxable is whatever your gain is, multiply by 50, you get a taxable. If you have a capital loss, you multiply by 50, we call it allowable capital loss. So taxable capital gain and allowable capital losses, they both are included in the net income when we're calculating Income Tax Act 3B. Now the next one we have is superficial losses for individuals. Now it's not a loss, we created superficials. That's what it means. If yes is answer to each of the question, a super loss is resulted. So we needed to know this. These are the 3 questions we have to ask ourselves. If it's a superficial loss, we are not allowed to claim that superficial loss under the Income Tax Act 42 and G. So that's what it is. So when we think of it, what are we thinking of superficial loss? First of all, was there a disposition of a capital? Was there a disposition of a capital property that results in loss? Means the selling price of the selling price was less than the cost. If that happened, you have to say, is this the case? Yes, it is the case. If it's the case, then your answer will be yes. Was the same property purchased in the period that began 30 days before the disposition? That means you own the property within the 30 days. So if you did that, they say, was the same property purchased in the period that began 30 days before the disposition and 30 days after it? If that's the case, then it's called a superficial loss. On 30th day after the disposition, does the individual still own that property? Then if you still own the property after the 30 days, then it is you're selling that property and it is on the 30th day after the disposition, then if your answer is yes, you have to have a yes answer. If your answer is yes to each of these questions, then we call it as a superficial loss. Means you are creating this loss. There is no loss. Then what you're going to do is you are not allowed to claim this loss, and your loss will be nil. Now we are going to go to capital gain reserve. So we have a reserve for capital gain. What happens is that you sold the property, you have a gain, but you did not receive all the money from the seller. That's what happened. All proceeds are not received in cash in disposition in the year it happened. If that happens, we are allowed to claim a reserve. So that's what happens. We're allowed to claim. This is normally a one of the question in the test or in an exam that we do or in a quiz. So what happens is, how do we calculate it? You calculate your total capital gain. This is the formula you needed to remember. What is the capital gain? You have a, we call it ACB. So you have an ACB. We have our proceeds of disposition. Your proceeds has to be more, and we call it a total capital gain, not a taxable. We call it a total capital gain. The proceeds, not now the money that the proceeds that we're supposed to get, we are not receiving that. If we're not receiving that, we're allowed to do the reserve. So what the reserve is, lesser of these two numbers. Whatever the lesser of these two numbers, that will be treated treated as a reserve. When we there's something wrong with my pen. It's just keep coming back and forth. I'm trying to fix it as we go because I needed to write what we're doing. So when we think of a total gain, you multiply the total gain by the proceeds not that is not payable until after the end of current year's taxable year divided by the proceeds. So this, if I were to think about it, this is your total proceeds. So this is what we supposed to receive from this customer or from the seller. So that's your total proceeds. So now they might give you some money and down, and some money is not paid. So the top number will be the proceeds not payable. Divided by that, and then you multiply by the total gain. Or what we're doing is the lesser of the both amount, the total gain, and then you multiply by the 20%. 4 is the number that is given to us by the Income Tax Act 40. So 4 minus number of preceding taxation years ending after the disposition. So these two are in our formula. So they are in your formula. You are going to get we're going to do one question. When I do the questions or an example, I'm going to do another video to explain it to you. But at this point, all we're doing is we're taking the lesser amount, and that will be treated as a reserve. Then what we have is, we have a restriction. We have a loss restriction on the sale of a land or a building. When you sell a land, and when you sell a building, that building is of course built on a land. When you sell both, how do you treat this? So when we sell a building, first of all, you could have a terminal loss because building is a depreciable property. If it's a depreciable property, then terminal loss is 100% deductible. You have a capital gain on the land, so only 50% is included in it. So that's what happens. So what happens is, why does it do that? It creates an incentive for manipulating. So Revenue Canada thinks that as the companies, they are manipulating their incentive. So what they wanted to do is, they wanted to allocate more. If you sold a property or sold a building for a loss, they wanted to put more towards the loss than towards the gain. Loss will reduce my income, gain will increase my taxable income. So it creates an incentive for manipulating the allocation of proceeds to the building to create a larger terminal loss. That's what they do. So it creates an incentive. If it creates an incentive, or we have a somebody finds the loophole, they're going to do that in order to close that loophole. The government did is they put a restriction on these losses. So they put a restriction on these losses so that we don't do this. The companies, as individuals or as a company, we don't do this. Now when you have a personal principal residence exemption, if you have a principal residence, of course the property value went up. If you have a gain, we do not pay taxes on the principal residence if there is a gain. Principal residence exemption applies where home is a personal property example, not a rental property. If it's a rental property, then there you have to pay the gain, taxes on the gain. So you can only only one taxpayer per family unit can designate a property as a principal residence. So that's what happens. So you are only allowed one principal residence. But if you have more than one residence, but one you have to make a principal, the other one you may have to make it as a rental property. When that happens, you have to do this calculation. So this calculation, your A is your capital gain. So A is your capital gain. So A minus your capital gain divided by B over C minus the D. What is B? Year designated as a principal. So which residence you wanted to be a principal residence? You wanted where there is more capital, where there's more gain. So if you have two properties and then you wanted to claim one as a residence, designated residence, the other one is you wanted to be a rental property. So it's saying years designated as a principal residence, and we have a +1. C is the number of years the property is owned, and ignore as it relates to 1994. So it is only relates to 1994. If any property was born in 94, then this happens. Otherwise this we ignore it. So now there is a star here. The star goes with your C. Ownership period include years of the purchase and the year of sale. So like we say that the year you purchase the property is it includes as a year. The year you sell a property, it also includes in a year. So when you calculate how long you have the property, you add these 2 years to the ownership of the property. Now next one is personal use property. When you have a personal use property, what happens in this case is that is this any property owned by a taxpayer and used primarily for a personal use, if it's or enjoyment for taxpayer or a person related to the taxpayer. So if you have something that is owned by you and it's for personal use, so this is word here is personal use property, then what happens is it could be automobile, home, such as a cottage. We think of vacation properties, boats, furniture, hobby items, and painting. Those comes under the description of personal use property. What happens is this is deemed, we say deemed capital gain on the sale of personal use property are taxable. However, there is a limit. What is the limit? The ACB, the minimum will be 1,000. Your proceeds minimum will be 1,000. In other words, in order for you to have a capital gain, you have to make the capital losses are not deductible. So they will not, on a personal use property, if you lose, if you sold the property less than the cost, you are going to have a capital loss. Capital loss is not a deductible when it's a personal use property. But if it's a gain, you have to pay taxes on it. That's how life is. So if it's a gain, you're going to pay taxes on it. If it's a loss, it's not deductible. Now we have something called limited listed personal property. So they're similar. What comes under that? A print and a drawing, a painting, a jewelry, manuscript, or a book. You collect stamps. Most people, it's a hobby for them to collect stamps and coins. They're subject to similar rule as is personal use property. The rule is same with 1,000. So again, the rule is minimum sold is 1,000, minimum cost is 1,000. Capital costs on listed personal property only deductible against capital gain. Here, you could claim a capital loss, but against your capital gains. So this will be talked about more in chapter 11. So then you'll be talking more about this in chapter 11. Going further, we have a capital gain and income tax planning. Of course, tax planning is that the legit way of not paying taxes to the government. So what is an advantage of it? Can control timing of the gain. So you sell it the year that there is a less income, or by delaying the disposition. Can use timing of if you have one asset that has a loss, the other asset you're going to have a gain. So the timing is important. In this case, structure of the sale of a capital property to take advantage of the capital gain reserves. Means capital gain reserves is when you don't receive all the money, you could structure the payments in a way so that you can use the reserve. So this was chapter 8, and now I am going to record another video. That video will be just taking up the homework of the important topic that is tested in the quiz or is used in a real life. So I will be recording that video. Thank you so much for listening to me, and thank you for subscribing to my channel. Take care and bye for now.